Our risk management approach has always been the corner piece of what we do. And what I've kind of said, internally is, making money is secondary. Our first core objective is to not lose money, as we kind of talked about a little bit first. So, managing risk first and foremost is kind of a fancy way of saying, like, how do you make sure you're not going to lose money? Like, that's just the better way to put it. And for us, that's about strict underwriting more than anything. And in having a third party fund administrator that does the financial analyses, it's about putting risk controls in place first and foremost. So first you say, how can I put myself in a position where I don't have to deal with the issue of drinking my own Kool-Aid? So in this particular instance, we'll look at a project, we'll go through the process. We do less than 1% of the deals that we actually look at. And I think that's we have so many deals that come to us, and it's very easy to be exuberant about a broker saying this deal is this, it's going to make $1 gazillion and 100 times its money or whatever. And then once you sift through that bullshit, then then you start to really run your own process. And once we've got to a place that we really like it internally at Rastegar, we hand that over to industry fintech, to our fund manager, and then their internal team of analysts that do not have a vested interest in the project, that whether we do the deal or don't do the deal, they're making the same, kind of, fee for looking at it. They run an analyses, and then we basically stress test the way that we had looked at the deal. And if between those two analyses, we find something that makes sense, or I should say three, because the broker runs, their analysis, we do our own, and then we have our admin go through it. And within those three kind of separate performas, we then come to a point where we feel comfortable, or I should say, have a high degree of certainty that we can execute on the business plan. We proceed. But the other part that we don't talk about as much is what are the varying exit opportunities? For example, multifamily. It's very easy to look at a multifamily project and see it through the lens of a cap rate. And here's your, net operating income, and here's what we believe we can increase rents to, or here's what the value add's going to be. It's 30,000 a door to renovate, or just this very typical way that you look at the deal. Fine. For us, we're also looking at the land that's underneath the multifamily project from a redevelopment standpoint. So we find that if there's varying ways to exit on your business plan, meaning if you go in there and you aren't able to raise rents as much, but the neighborhood is gentrifying, or I like to say the community is enhancing, you can then bulldoze it, rezone the property, increase the value, and then build class A, right? So having varying ways that you can execute, I think, is one of the most profound risk management tools, because you're not like pigeonholed into one strategy. Like when we bought an office building in Austin, it was 1960s product, unbelievable location, one of the richest zip codes in Texas. And one of the ways we looked at it is, even before this office debacle, we looked at a condo conversion strategy. So it's not necessarily what we wanted to do at the outset, but we have a separate business plan in place that if everything went to hell in a handbasket, in this instance it actually did, we could go through a recapitalization, convert it into condos, and still be able to execute. Because at the end of the day, for us, it's about, it's the old cliche, and cliches are cliches for a reason. The location, 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 right? And that's always been the strategy, is how do we figure out first that if we have to sell at a fire sale, we're not going to lose our capital. First, we might not make our promote, but that's secondary to me, as first as saying, let's not lose our investor capital to make sure that we can live to fight another day, and having various ways to execute on our plans in varying environments. And with you take the confluence of all of those things together, I think you end up having a higher degree of certainty that you can create alpha. Leverage really gets a bad name. I mean, this question is a very loaded question, because the typical answer is, well, we don't go above 65% LTV, or whatever. And that's just bullshit. Like we've levered up to 75, 80, 85%, because sometimes you have to look at it through two lenses. One is LTC, loan to cost ratio. Then there's LTV, loan to value ratio. So on a cost basis, we might have 80%, 85% leverage. But if I'm buying it for 50 cents on the dollar, I don't want to be penalized for using higher leverage on its face and not be able to get the type of returns that we're looking for. So on a multifamily project, we bought a lot of 1960s, 1970s vintage product that are on massive land sites that we can redevelop in the future. So we can go in and buy those for a little bit less equity, and from a multifamily standpoint, quote, have more leverage, at the beginning, but we know we can redevelop it and go hit a 30 IRR. I don't have a problem using the leverage as long as the value mechanism isn't out of balance. So that's the main point, because a lot of times we're buying things, at very attractive costs. So as I said, on a loan to cost basis, it looks like the leverage could be high, but on a loan to value basis, you're at 30% leverage. So it's not a question that can be answered in a vacuum. It's on a deal by deal basis. But do we want to be over levered with super high octane debt? No. First thing about construction risk is we don't do any of the construction in-house. And being an attorney, I want somebody to sue if something goes wrong. And the construction business, the margins, aren't as sexy as we like, and the risk is predominantly higher. So the first thing that we do to manage construction risk is we RFP the bids. So we'll go out and look at the whole market from a general contractor standpoint, and we're underwriting their execution risk, their track record, their insurance, how they source projects, et cetera. And then we oversee the construction more from a construction management role and don't take on the risk of executing and getting the subcontractors and dealing with all the mechanisms which people do, that are vertically integrated. They want to run the construction. We want to be in the investment business. We don't want to be in the construction business. Some of the things is par for the course, in the sense of you can't control the uncontrollable, and this is not, there's nothing about this is guaranteed. So the risk reward ratio is the first thing you just have to accept, right? But when you invest in markets that are based around population migration growth and around corporate relocations, you might not know, in that exact, you want to execute and break ground in 9 months. Well, you might be wrong about that, but it's very hard to be wrong about the market on a longer term basis. So the first thing we do is manage the investor expectation of saying, this is not a fix and flip. So in a 2-year, 3-year, 4-year, because the way that we're structured, we're not rewarded for capital raising, meaning that we need to make money, break the preferred return, and get into the promote to make money. So we have an alignment of interest to be able to actually go make money, because we make money with our clients. But with that said, there has to be a buffer of time, and you have to manage those expectations, and you shouldn't be in private equity if you're not prepared to wait for 5 years. So I can say, we think this is a 3-year, 3 to 4-year time horizon, but the reality of it is you need to have the stomach as an investor to know this could take 5 or 6 years. And because sometimes you go in and you prime it, you buy, it's great examples right now. We have some of the best land located in the entire city of Austin and entire Austin MSA. Technically, a couple projects are a year and a half delayed from what we saw, but now the pent-up demand and the value creation has been so dramatic that we're crushing our pro formas. So we were wrong on the exact time, but we were fundamentally right on the markets that we invested in. So you have to create just a very transparent buffer that the timing just could vary. And we're not talking about varying for 10 years, but if you can't have the stomach to have an 18-month or a 2-year exit buffer, these deals you shouldn't do them. You should just buy an index fund. It is probably one of the most mission critical pieces to the success of Rastegar. Okay. And more importantly, the era that I was raised in, and a lot of other investors, is this Bernie Madoff kind of era of people. And to me, being an attorney, I spoke with my father when I started the firm and basically said to him, what if people, you're talking, you have exuberance and this passion, you're in a fancy suit, you have a shiny smile, what if people think that it's smoke and mirrors? And, it kind of hurt my feelings in the beginning. People are like, oh, well, are we sure this is okay? Are you sure you know what you're doing? And my dad kind of depersonalized it for me. It's like, hey, people are skeptical. They've been burned. How can you set up a risk control to ensure that their skepticism can be quelled? And that's where a third-party fund administrator comes in, meaning at Rastegar, we don't touch any money at all. Meaning when an investor, for an investor protection standpoint, there's a few things that you can do. One is don't touch money ever. So when an investor wires money into a deal, it goes into a third-party fund administrator's escrow account, and that's exactly what it is in the sense that it's a third party. They don't have a vested interest in the deals. They're paid on a cost basis for processing a certain amount of documents, for a certain amount of quarterly reports. And so they're not in the profits of whatever the deal are, one. And then when the money comes in, an investor says, oh, let me look at this. The data rooms that they access, the pro formas that they access, the documents that they access are all managed by a third party. So that when the investor actually says, I want to invest in XYZ deal, the third party ensures that that is the deal that they're investing in. And then they also handle the accounting and they handle the books so that somebody that might, if something was going wrong or this, that, or the other, there's no possibility that somebody on the Rastegar side could then start to alter numbers. And it takes that, it makes me sleep better at night, first of all, because if someone says, oh, well, this is wrong with whatever, I can say, fuck you, go, don't call me. Like, I don't know. I don't even do any of that. I don't send money. I don't touch money. They follow what the documents say. And that just is what it is. And then beyond that, we have an auditor that then audits the financials of the third party admin. So that's my way of making sure that my admin is doing the right thing. So a lot of investors think that audits are for them. Audits are for me. So it's back to that tiered approach. We find the deals. We have a separate party look at the numbers. Then we have the broker look at the numbers. Then the investors go and they look at the investment packages and look at the deals, and they've seen these varying lenses of risk controls. Then the money comes in to a third party that follows a strict guideline of what the documents dictate of how money is spent, how expenses are reimbursed, or whatever those things are. And then at the end of the year, a third-party auditor like EisnerAmper or KPMG or Deloitte goes in and then checks the work of the fund admin for me as the manager and for the investor. So those tiers of risk controls, at the very least, the investors in Rastegar know that what they think they're investing in, they are investing in. Hard stop. Does it guarantee it's going to go up? No, I'm not a psychic. But it does guarantee that the numbers that we assumed were ones that were based in reality. The way the documents are structured, the way quarterly reports are done, the way that distributions are made or not made are all in line with how the documents are supposed to be done. So the numbers are the numbers, and you don't have to take my word for it. That's kind of one of our competitive advantages, because for a firm of our size, this is what the Blackstones and the Carlyles and the KKRs, like this is what the huge institutions require. Like our investors are predominantly public pension funds and insurance companies. Okay, so yes, we have doctors and lawyers and professional athletes and celebrities, all these kind of whatever, but most of our money is institutional. And by having that, you can then check the diligence boxes for the institutions. This is what they want to see. So we designed this to be an institutional shop from day one, and it helped us get institutional capital in the first year. Very first year of the firm's history, we landed a huge public pension fund out of Louisiana. And so this was the differentiating factor. This is what's allowed us to grow, what's allowed us to attract some of the biggest banks in the world, some of the big, the right deals. But that is the real sauce. If I'm an investor looking at varying firms and all things are being equal in the deals, I want to make sure that my money's safe. And the only way you can really do that is to make sure someone without a vested interest, the lawyer in me, is watching the money, adhering to the documents, and then an auditor is watching them, and you have internal regulations built in. So you don't need to trust me, you can trust the process. The admin that we use is also a business administrator, and they're a technology company at their core, okay? Which, so much of what we do at Rastegar is technology driven. It's not technology it's technology driven in the sense where the numbers tell the story, because we're a very human organization. Like, we believe that real estate ends in people. And I tell our team all the time that we want to marry humanity and mathematics. We want to make sure that we are doing the things for the people, so to speak. And that's why when you look at a corporate relocation, these are people moving their families. Where do they want to live? Where do they want to eat? Where do they want to shop? these are the core tenets of kind of what we do, but using technology and data to inform better decisions is where we like to be. We want to see as much information. I'm a data freak. I want to see it never hurts me to know more. If that makes sense, I don't want to be an ostrich and put my head in the sand. We'd like to see all the varying, conflicting opinions, populations up, populations down, prices are up, prices are low. And then we can then use all those varying pieces and use the technology backbone of our admin to make better decisions for our investors, find the right angle around individual deals, but at the same time, maintain a level of human orientation around the why, so to speak, we're doing this. We are building apartments for people to live in. We're building homes for people. We're building logistics centers so that people can get their Amazon packages on time. And that's the big difference of, this is not just numbers on a spreadsheet for us. Like there's been deals that I look at and the numbers on paper look absolutely incredible. And I walk the neighborhood and run for my life. So that's the other part about this business, being an English major and being an attorney. The humanity around what we do is a very, very big component of the diligence. It's a whole, and again, it varies on the type of project and where it is, meaning a multifamily project, there's a very vanilla process of looking within a certain amount of miles, how many other apartments are, what are occupancy in the areas, what have rental rate growth been. There's lesser minds that have achieved more in looking at very, a few static pieces. And then you're doing foundational look, you're looking at the roofing, this is a very systematized approach when you're just buying multifamily as an example. But if you're buying raw land that you're getting entitled, and then you're bringing in sewage systems, you're building roads, you're building infrastructure, there's a whole other slew of things that go into it. You're looking at macroeconomics, you're looking at, national averages, which I usually hate, because I very much believe in buying the block or buying, the center. But the more, the more remote the project and the longer timeline, the larger macroeconomic study that's needed. For just buying existing real estate, there are checklists for days that you can get on YouTube that'll tell you of what to actually look for. And as long as you trust the process and you go through and you check all the different pieces from a structural standpoint, from a financial standpoint, from an occupancy standpoint, from a forward moving growth standpoint, that part isn't rocket science. The hard part is figuring out how to get a bank to lend you the money and how to figure out how to get a public pension fund to give you the equity. There's people that can find deals all the time. They just don't have any money. We happen to be able to do both.